When it comes to the end of the tax year, 5th of April by the way, we're always asked, gosh, must be a busy time for you, mustn't it? I always say, no, we do all the tax year end stuff well in advance. We try to use ISA allowances for clients much earlier in the year. And then, of course, we find ourselves doing stuff right down to the proverbial wire. So as we hit the end of Feb, and we can feel we've made it through winter to March blossoms, and there's just 6 weeks to go with a budget in between to that mythical end of the tax year, here are some reminders of things to think about if you haven't already. The budget, incidentally, used to bring quite a few surprises and some additional deadlines when they abolished allowances, and they announced this just before the end of the tax year in a couple of weeks. Or there might be stuff to get in quick with before new taxes come in that same couple of weeks. But hopefully some lessons have been learned, and the autumn statement has been introduced, and that effectively became another budget. And most of the changes nowadays are flagged up well in advance to avoid the sort of panics, or, as used to happen, financial services sales binges. Older viewers may remember mortgage and life assurance tax relief and their abolition. Anyway, assuming on that basis that we don't have any budget surprises, what should you be thinking about, or better still, actually doing? Well, ISA allowances I've mentioned. They are 20,000, cash and stocks and shares, and you get another one from the 6th of April. Same applies to junior ISAs for children and grandchildren, £9,000 each. Pensions, the total you can pay in is the higher of your income, or £60,000, less anything you've already paid into a workplace, auto-enrolment or other sort of pension. If you're lucky enough to earn more than 60,000 and want to pay more than that in, you can go back over previous years and bring forward unused allowances, but I'd get help on this. Can get pretty complicated. We have helped a few clients this year who've had big redundancy payoffs to pay a chunk of that into a pension and bring down their tax bills, so that's worth thinking about too. Also, very importantly, a number of allowances are going down, and some of those in quite a big way. If you have shares or investments to sell, capital gains tax may well be payable if you made a profit on profits of anything over £6,000 in this tax year and £3,000 in the next tax year. The amount you can earn in dividends before you pay tax is going down from £1,000 in this year to just £500 next year. Not much you can do about that one, or about the tax which might be due on bank and building society account interest. Now, when interest rates were next to nothing, this wasn't a problem for most people. But if your other income is more than around 17,000, you'll need to pay tax on any interest that's earned over £1,000 in this tax year, which you would have earned in most accounts with around £25,000 to £30,000 in them, with rates at 4% or so. Now, all of this will mean that a heck of a lot of people who've never had to do a tax return will need to start. It's up to you to declare it, not to the tax man to tell you should. That's a whole other story for another day, probably in the new tax year.